Ever wondered where billionaires park their money to make even more money? Welcome to the mysterious world of hedge funds. You won't see TV ads for them, and most people can't even invest in one. But they move billions behind the scenes and can shake up entire markets. Today we're going to break down what a hedge fund is, where they came from, how they work, who runs them, and why they matter. We'll talk about the strategies they use, the risks they take, some wild success stories, and a few crashes too. So grab your popcorn and let's get into it. Welcome to Mavic Finance, where we explain investing concepts in a simple way. By the way, this video does not contain any financial advice. So, what is exactly a hedge fund? Let's say it is like a private investment club for the super rich, run by expert money managers who try to grow that money crazy using all kinds of creative and risky strategies. They're not for regular investors, and they don't play by the same rules as your average mutual fund or retirement account. Hedge funds actually started way back in 1949, thanks to a guy named Alfred Winslow Jones. He had a clever idea: buy stocks he thought would go up and short stocks he thought would go down. Shorting means borrowing shares and selling them, hoping their price drops so you can buy them back cheaper later, making money when a stock falls. It's way riskier than just buying stocks, because if the price goes up instead, losses can be huge. By mixing these moves, he thought he could hedge his bets and lower risk. This new way of investing caught on, and over time, hedge funds became the big players we hear about today. You've probably heard of mutual funds or ETFs. Those are investment options most people can buy into. However, not just anyone can invest in hedge funds. To qualify, you usually need to be an accredited investor. That means having a net worth of at least $1 million, excluding your home, or earning over $200,000 a year individually, or $300,000 with a spouse for the last couple of years. These rules exist because hedge funds are riskier, and regulators want to make sure only people who can handle big ups and downs jump in. They're less regulated, which means more freedom, but also more danger. Think of mutual funds and ETFs like your everyday cars, while hedge funds are more like race cars, faster, riskier, and not for everyone. Hedge funds don't run themselves. At the center, you have the fund managers. These are the pros making all the big calls about what to buy, sell, or short. Then, there are the investors, usually super rich individuals or big institutions like pension funds and universities. Behind the scenes, there's a whole team of researchers who dig up information about companies or markets, risk managers who watch out for potential losses, and legal experts who keep everything on the right track. Hedge funds don't just buy and hold stocks, they get creative. Some play it safe, investing in companies they believe will grow steadily. Others use wild strategies like betting against stocks, trading currencies, or investing in weird assets like art or real estate. Some even use fancy math and computers to make split-second trades. The goal? To make money no matter which way the market moves. Hedge funds are known for going big or going bust. Because they use risky strategies and sometimes borrow money to invest more, the potential rewards can be huge. But that also means losses can be massive if things go wrong. Hedge funds have a unique way of charging fees, often called 2 and 20. Here's how it works. First, they charge a 2% management fee. That means if you invest $1 million, they take $20,000 every year just for managing your money, whether they make a profit or not. On top of that, they charge a 20% performance fee, which means they take 20% of any profits the fund makes. So, if the fund earns $100,000, the managers get $20,000. This setup can be great for fund managers because if they do well, they earn a lot. But it also means investors are paying even when the fund doesn't do well, thanks to that fixed 2% fee. Some people criticize this system because it rewards managers heavily, even when returns aren't amazing. Still, it's the standard model in the hedge fund world. When it comes to hedge funds, a few names stand out because of their size, success, and influence. One of the biggest is Bridgewater Associates, founded by Ray Dalio. Dalio built Bridgewater into the world's largest hedge fund by focusing on a simple but powerful idea: prepare for every kind of economic weather. His all-weather strategy spreads investments across different assets, stocks, bonds, commodities, to protect against crashes and booms alike. He treats the economy like a giant machine, using data and history to predict what might happen next. This approach helped Bridgewater manage risk better than most and earn steady returns through market swings. Another giant is Renaissance Technologies, run by Jim Simons, a former math professor. This fund is famous for using complex math models and computer algorithms to find hidden patterns in the market. Their flagship fund, the Medallion Fund, is legendary for delivering consistently huge returns. But it's only open to insiders, making it almost mythical in the investing world. And then there's George Soros, who became a legend in the 1990s for breaking the Bank of England. Soros famously made over $1 billion by betting against the British pound during a major financial crisis. His bold moves showed how a hedge fund could shake the entire global economy. We'll talk about ethics later. Hedge funds are often seen as money-making powerhouses, but they've had their share of dramatic failures and scandals. Take long-term capital management, LTCM, for example. It started out incredibly well, with annual returns of around 21% in its first year, 43% in the second, and 41% in the third, after fees. Sounds impressive, right? But in 1998, things took a sharp turn. Because LTCM used massive amounts of borrowed money, called leverage, and was heavily exposed to the fallout from the 1997 Asian financial crisis and the 1998 Russian financial crisis, it lost $4.6 billion in less than 4 months. Beyond LTCM, hedge funds have also been caught up in legal trouble over insider trading and other shady practices, feeding a reputation for being secretive and sometimes operating in the shadows. Hedge funds aren't just money machines for the ultra-rich. They can actually shape entire parts of the economy. Because they move huge amounts of money, their decisions can sway stock prices, pressure companies to change their strategies, and even impact job markets. Some hedge funds are known for activist investing, where they buy a big piece of a company and push for major changes, sometimes improving performance, other times leading to layoffs or restructuring. There's also a growing conversation about ethics. Are hedge funds just playing smart, or are they exploiting the system? Some people criticize them for profiting off of financial crises, or for using strategies that hurt smaller investors. Others argue they bring liquidity to markets and help correct mispriced assets. So while most people won't ever invest in one, hedge funds still have a big influence on how the financial world works. And hey, even if you're not a billionaire yet, who knows? Stick around, subscribe, and keep watching my videos. Maybe one day you will be. If you liked this video, you will probably like this one as well. Thanks for watching and see you very soon. Bye.